Welcome to Investing in Asset Management. In this presentation, we'll explore the foundational concepts of investing, how to evaluate and manage risk, and how to make informed decisions that align with your financial goals. Learning objectives for this session include three key areas. First, you will understand the basic principles of investing, including the relationship between risk and return. Second, you will learn how to identify and measure different types of investment risk. And third, you will explore a range of investment vehicles, from individual stocks and bonds to mutual funds and exchange-traded funds, so you can determine which options best suit your financial situation. By the end of this presentation, you'll have a solid foundation for building and managing a portfolio that works toward your long-term financial goals. Before we dive into investing, it's important to start with the basics of financial security. A key principle of sound personal finance is maintaining an adequate savings cushion. Financial experts generally recommend keeping between 3 and 6 months' worth of living expenses in an easily accessible savings account. This emergency fund serves as your financial safety net. It protects you from having to liquidate investments at an inopportune time, for example, during a market downturn, just to cover an unexpected expense. Adequate liquidity means you have enough cash or near cash assets available to meet your short-term obligations without disrupting your long-term investment strategy. Think of your savings as the foundation of your financial house. Before you invest, make sure that foundation is solid. Only money you won't need in the short term should be directed toward investments, where it can be put to work, growing over time. Now let's talk about one of the most fundamental concepts in investing, the relationship between risk and return. Many people misunderstand the concept of risk and return to mean that higher risk investments will provide higher returns. Taking on more risk does not guarantee a higher return. What this concept actually illustrates is that the potential of a higher return would need to be available in order for a rational investor to take on more risk. Risk refers to the possibility that an investment's actual return will differ from what was expected. This includes the possibility of losing some or all of the money you invested. Return, on the other hand, is the gain or profit you receive from an investment, typically expressed as a percentage of the amount invested. Investors who are willing to take on more risk, such as investing in volatile stocks or emerging markets, have the potential to earn higher returns over time. Conversely, lower risk investments like government bonds or savings accounts offer more predictable but generally lower returns. Understanding your own risk tolerance is a critical step in building an investment strategy. Your risk tolerance is influenced by factors like your investment time horizon, financial goals, income, and personal comfort with uncertainty. To make informed investment decisions, it helps to be able to measure risk in a quantifiable way. Two of the most commonly used measures of risk are standard deviation and beta. Standard deviation measures the variability or dispersion of an investment's returns around its average return. A higher standard deviation means the investment's returns fluctuate widely. Some years might be very high, others very low. A lower standard deviation suggests more consistent, predictable returns. For example, a stock with a standard deviation of 25% is considerably more volatile than one with a standard deviation of 5%. Beta, on the other hand, measures an investment's sensitivity to movements in the overall market. A beta of 1.0 means the investment moves in lockstep with the market. A beta greater than 1.0 means the investment is more volatile than the market. It will rise more when the market rises and fall more when the market falls. A beta less than 1.0 indicates less sensitivity to market movements. Together, standard deviation and beta give investors a clearer picture of how much risk they are taking on, and they are essential tools for comparing different investment options. There are many different types of investments available, and each comes with its own risk and return profile. Understanding the major asset classes is essential for building a well-rounded portfolio. Stocks, also known as equities, represent ownership shares in a company. They offer the highest potential returns over the long term, but also carry the most risk. Bond investments involve lending money to a government or corporation in exchange for periodic interest payments and the return of principal at maturity. We call these fixed income investments because the interest you earn on the money you lent is paid in fixed amounts on a set schedule. Because of this feature, bonds are generally less risky than stocks but offer lower returns. Real estate investments can provide both income through rent and capital appreciation. Commodities include natural resources like oil and agricultural products, and alternative investments encompass a broad range of assets, including digital currencies, hedge funds, private equity, and collectibles. Diversifying across these asset classes is one of the most effective strategies for managing risk while still pursuing growth in your portfolio. When it comes to building an investment plan, your goals should be the starting point. Investing without clear goals is like driving without a destination. You may move, but you won't necessarily get where you want to go. Start by defining what you're investing for. Are you saving for retirement, a child's education, a home purchase, or long-term wealth building? Each goal may have a different time horizon and risk tolerance associated with it. Consider your investment time horizon, how long you have before you'll need the money. Longer time horizons generally allow for more risk since you have time to recover from market downturns. Shorter horizons call for more conservative investments. Also, think about your current financial situation, including your income, expenses, debts, and existing savings. The amount you can afford to invest regularly, combined with the power of compound growth over time, can make a significant impact. Your individual preferences or unique circumstances refer to your beliefs and values as an investor. For example, some investors may avoid certain investments based on their values or not wanting to invest in a particular industry because of negative associations with that industry, such as environmental or humanitarian concerns. Finally, revisit your investment plan periodically. Life circumstances change. A new job, marriage, children, or approaching retirement can all shift your goals and risk tolerance. Regular review ensures your portfolio stays aligned with where you want to go. No matter how carefully you invest, risk can never be completely eliminated, but it can be managed and minimized. There are several key strategies investors use to reduce their exposure to risk. The most well-known strategy is diversification. By spreading your investments across different asset classes, industries, and geographic regions, you reduce the impact of any single investment performing poorly. The idea is simple. Don't put all your eggs in one basket. Capital allocation is diversifying your capital between risky and riskless investments. We consider the returns from investing in U.S. Treasury bills, i.e., lending money to the U.S. government, to be fairly risk-free because the U.S. government is very likely to pay us back. If we could earn, say, 4% on lending money to the government risk-free, then we would intuitively need the potential of a higher return than 4% to get us to put our capital at risk. Asset allocation, deciding what percentage of your portfolio to place in each asset class, is closely related to diversification. A well-thought-out asset allocation strategy balances growth potential with risk management based on your individual goals and time horizon. Rebalancing your portfolio periodically ensures that your asset allocation doesn't drift too far from your target, as some investments grow faster than others. And maintaining a long-term perspective helps you avoid making emotional decisions during short-term market fluctuations. Security selection is the third step in diversification, choosing individual investments within each asset class. Here is the chance to achieve industry or sector and company diversification. For example, if you decided to include corporate stock in your portfolio asset allocation, you decide which corporation's stock to invest in. Choosing corporations in different industries or companies of different sizes or ages will diversify your stock holdings. You will have less risk than if you invested in just one corporation's stock. Diversification is not defined by the number of investments, but by their different characteristics and performance. Two of the most popular investment vehicles for individual investors are mutual funds and exchange-traded funds, commonly known as ETFs. Both allow investors to pool their money together to invest in a diversified portfolio of securities, making them accessible even to those with limited capital or investment experience. A mutual fund is a professionally managed investment fund that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. The fund is managed by professional portfolio managers who make decisions about which securities to buy and sell based on the fund's stated investment objectives. An exchange-traded fund, or ETF, is similar to a mutual fund in that it holds a collection of securities, but it trades on a stock exchange just like an individual stock. ETFs typically track a specific index, such as the S&P 500, and are known for their low costs and flexibility. The S&P 500 refers to the largest 500 companies traded in the US and is used as a proxy for holding the whole market, because the market cap of these largest 500 firms represents the bulk of the US stock market. Both mutual funds and ETFs offer investors a way to achieve diversification without having to individually select and manage a large number of securities, making them excellent tools for both beginner and experienced investors. Mutual funds offer a number of compelling benefits that make them a popular choice for investors at all levels. Professional management is one of the primary advantages. When you invest in a mutual fund, your money is managed by experienced investment professionals who conduct research, analyze securities, and make informed decisions on your behalf. Diversification is built in. Because mutual funds hold a wide variety of securities, the risk is spread across many investments rather than concentrated in just one or two. Mutual funds are also accessible. Many funds have relatively low minimum investment requirements, making them available to investors who may not have large sums to invest. And because they are regulated investment products, they offer a level of transparency and oversight that provides additional investor protection. Automatic reinvestment of dividends, ease of purchase through brokerages and retirement accounts, and a wide range of fund types, from aggressive growth funds to conservative income funds, give investors significant flexibility to match their investment style and goals. Exchange-traded funds have grown tremendously in popularity over recent decades, and for good reason. They offer several distinct advantages over traditional mutual funds and individual securities. One of the most significant advantages of ETFs is their low cost. Because most ETFs passively track an index rather than being actively managed, they have lower management fees, known as expense ratios, compared to actively managed mutual funds. ETFs also offer intraday trading flexibility. Unlike mutual funds, which are priced once per day after the market closes, ETFs can be bought and sold throughout the trading day at market prices, giving investors greater control over their entry and exit points. Tax efficiency is another key benefit. ETFs tend to generate fewer taxable events than mutual funds because of the way they are structured, which can help investors minimize their tax liability. Transparency is also a hallmark of ETFs. Most ETFs disclose their holdings daily, allowing investors to see exactly what they own. Combined with their broad diversification and flexibility, ETFs have become a cornerstone of modern portfolio construction for both individual and institutional investors. Let's take a moment to review the key concepts we've covered in this presentation. We began by establishing the importance of maintaining adequate savings and liquidity before investing. We then explored the fundamental relationship between risk and return, understanding that higher potential returns come with higher risk. We covered how to measure risk using standard deviation and beta, and we surveyed the major asset classes available to investors, including stocks, bonds, real estate, and more. We discussed how to align your investment strategy with your personal goals and time horizon, and we explored strategies for minimizing risk, including diversification, asset allocation, dollar cost averaging, and rebalancing. Finally, we examined two of the most widely used investment vehicles: mutual funds, which offer professional management and built-in diversification, and ETFs, which combine low costs, tax efficiency, and trading flexibility. With these tools and concepts in hand, you are well equipped to begin building or refining an investment strategy that supports your long term financial success.